CA Drishti Desai, CA Arpitji Kabra, both perhaps in absentia now, but I just want to recognize their presence. My co-speaker, CS Vishwas Pathakji, and all the dignitaries of WIRC. I think Drishtiji is back. I had a chance to interact recently in the evaluation.
Abhijit sir, everybody will be logged in, but they will be switching off their camera for the sake of.
Okay. So I just had a chance to interact with her recently in the evaluation study group about which she mentioned. And all my dear CA friends, thank you for this opportunity for addressing this August gathering. So with your permission, I'll show my screen and I'll begin with my presentation. I hope it's visible. If you could kindly confirm that it's visible, then I'll go ahead.
Yes, it's visible, sir. Please go ahead.
Okay, excellent. So as Abhijit mentioned, the topic which is given to me is lessons from pandemic and the importance of financial well-being as an enabler to professional progress. In fact, we all know that these have been trying times, and therefore, if we were to look at some of the key learnings from this pandemic, one of the most important things has been the criticality of health and importance of life itself, as we have all experienced some of the tragic deaths around us. It has also prompted us to introspect the life priorities. Obviously, families first, and their health is first. That's something which is very critical and important. And as they always say, cricket is a game of glorious uncertainties, and we also experience that in our life, how gloriously uncertain this period was, and particularly for professionals like us. At the same time, there was a clear need for us to keep our positivity going to get over the gloom. I remember I created a series of Marathi videos beginning from March 25th of 2020 and ending on about 14th of April, every day sharing my thoughts on the silver linings of this pandemic so that we don't get bogged down with the negativity and instead look for opportunities. It also emphasized the importance of spirituality, the very important dimension of our life. And we also experience as a part of our own professional activities, major shifts getting accelerated. A lot of us had to work from home, from typical brick and mortar businesses. Businesses are getting virtual. We also experience that kind of a transition. But the core of this topic, which is what I also wanted to emphasize, was that the biggest learning was that financial well-being is so critical to manage other challenges. Imagine the situation that, the challenges that cropped up for people who also had financial issues. They are like two battles being fought at the same time. And we have heard of all kinds of very sad stories. So one of the biggest learning is that we have to take care of our own financial well-being so that we are able to actually cope up with the challenges and also blossom in our own professional progress. So backup of well-managed investments can help us during uncertain times. As Abhijit introduced me, I played senior roles among some of the global organizations. But last 2 decades after I decided to pursue my doctoral work from IIT Bombay, and practically for 2 decades, I have been doing work for corporates wherever I am invited. I don't do any networking or outreach. And I have personally been experiencing that only because I have had a well-managed investment portfolio that I have been able to cope up with these uncertainties. Because unlike traditional CA practice, where at least you have ongoing clients for audit and taxation, in my case, because I'm more in consulting, coaching, corporate executive education, there's a lot of uncertainty about what work will come my way, particularly because I don't want to go and pitch myself. I would rather get invited. So that being the case, for me, this experience during COVID was not new, though of course it was more severe because lack of a lot of these initiatives by corporates during this time to engage executives through workshops because of a lot of challenges that they had on their work front. So obviously I had to undergo a lot of challenge from a professional activity perspective, but only because I have been managing my own investments well, that I've been able to cope up with that and in fact create opportunities, on which I have created a series of videos. As Abhijit introduced, I have my own YouTube channel on which I have shared a lot of those thoughts. But I wanted to focus on some of the very important dimensions in the limited time that I have. So obviously, when we talk about financial well-being, savings, investments, loans, and insurance are the typical 4 dimensions. I'm going to touch upon very briefly on the other 3, which is savings, loans, and insurance. But my focus today is going to be on investing. So very quickly, I'll talk about the other 3 dimensions and then move to my core subject. And depending on the time available, I'll be very happy to take questions. So first of all, criticality of savings, right? This pandemic underlined the importance of savings once again, right? And one very important learning has been that savings are deeply influenced by the lifestyle that we have. And whether we like or not, lifestyle is a very sticky business. It can't be changed easily. So we have to live with, the nature of expenses once we opt for a lifestyle. So, for example, when I was working for these global organizations, I had a choice of staying in South Mumbai, maybe in a leased apartment, but I consciously stayed away from that temptation because I was very watchful of my lifestyle. Because once you move to locations which are the upmarket locations, your lifestyle undergoes a complete change, right? So this pandemic in a way emphasized the importance of simple living. We always say simple living and high thinking, but this pandemic really emphasized the importance of that, right? It also emphasized, very interestingly, the importance of sharing and caring. It's not just a question of taking care of ourselves, but there are a lot of these have-nots that we also need to attend to. And I'm sure many of you would have contributed. Personally, I reached out to many people whose livelihoods were affected, and I at least tried to give them some financial support during this time. So the key learning also is that while we need to save, it need not be only for our selfish ends. It can be to ensure that we are able to extend a helping hand during these trying times, because as our own culture teaches us, our well-being is not possible without well-being of others. So we have to take care of well-being of others also. And this attitude of thinking beyond us is actually critical for our own inner well-being. So only when we take care of others, we get taken care of. So I slightly digress, but I thought that's also a very important part of our lifestyle. The second important aspect is, of course, insurance. So term insurance, health insurance, property insurance, vehicle insurance, keyman insurance. We have, being chartered accountants, we all know about these insurance opportunities. But as they often say, insurance is actually a subject matter of solicitation. So in principle, it should be always asked for, but it should never be sold. But what we see in reality is that we see it the other way. We find that insurance is aggressively sold rather than being bought, right? So we should surely seek protection whenever we feel vulnerable in certain domains, particularly those of you who are young, you're still building the career, savings are not sufficient. It's absolutely important for you to have your insurance cover to protect from your vulnerabilities. So term insurance is very critical. Health insurance is also very important, and so are others. However, what I would also mention is that insurance must be used judiciously, or else, unfortunately, we also heard cases this time, like it happened with a friend of mine, that he was admitted to a hospital having been diagnosed of COVID, and a question was asked to him, how much insurance does he have? And he said, naively, that he had insurance of 10 lakh rupees. After a couple of hours, somebody came back and said that, your bill will be approximately 10 to 12 lakhs. This is very first day of being admitted. And then he was stuck into the hospital for 15 days, and finally the bill was about 11, 12 lakhs. Now, this is a gross misuse of insurance protection. So it must be used judiciously. Otherwise, such a use will finally jack up the insurance premium so high that the have-nots from our society will suffer. So this is where we need to be very careful in terms of the use of insurance products. And lastly, we should never mix up insurance with investing. Unfortunately, a lot of insurance products get missold as great investment products, but that should never be done as a reality. Going to the loans part, taking loans judiciously is very important. So loan for one's own residence and where one is going to stay, of course, it's a great idea because that's something which is very important for our own well-being. But when it comes to taking a loan for real estate investment, we need to be very careful. Quite often people get trapped in very long real estate cycles. So unlike equity markets, about which we're going to talk about later, real estate cycles really go on for a very long time, and people actually unfortunately get trapped. And the worst is they may have taken loans for those investments. So on one hand, the real estate investment may not perform, and on the other hand, there is a burden of the loan. So we have to be very careful about real estate cycles. Car loans, we need to be aware about the new trends. Car today is moving from something to be manufactured and sold to car as a service. And therefore, putting money into an asset which is going to depreciate, particularly when there are new trends, new technologies which are coming, we need to be more careful. Right? Education loan is a great idea. As Abhijit mentioned, I helped IIT in launching a joint degree program with an American university. And such aspirational programs, if one is required to take a loan, that's worth it because it opens up new opportunities. And of course, personal progress through education is something very important for all of us. But when it comes to other needs such as white goods, tourism, we have to be very judicious when we take loans because those burdens is something we need to create very carefully. Also, we should avoid credit card rollovers because all of us must be aware that credit card rollovers actually are very expensive. The rate of interest which is charged because they are unsecured loans are extremely high. So we should use credit card more from a liquidity management perspective rather than a real credit. So this is something I thought of just mentioning before I move into the core discussion I wanted to hold on the investing per se. So simply said, what is investing? We all work hard, but investing is about making our money work hard, right? So our saving pool must work hard enough as we work hard. That's the simple idea. So in my view, after having been in it for many years now, one of the biggest learnings that I have had in investing domain is your investing is as effective as you are able to understand and manage risks. So what is really important is that we should focus on risk and risk management. In my experience, returns follow. Unfortunately, what people do is they try to run after returns and then they invite risks. And that is more speculation rather than investing. Investing is really about understanding risk and then automatically we ensure that returns will follow, right? Also, it's very important that we should stay away from rigid age-based prescriptions. For example, I am going to turn 59. If you ask a typical financial planner, the financial planner would advise me not to have an equity exposure more than 50%, 40 to 50% at the most. But I just wanted to give a disclosure that 95% of my savings are in equities. So I am going against the so-called prescribed wisdom. But as I mentioned earlier, that if you are able to understand and manage risks, it's up to you to actually increase the exposure. So age is not a bar. So we should not actually get influenced by many of these rigid prescriptions which are given, and we should also stay away from the potential mis-selling. For example, SIP is a product which is, in my view, grossly mis-sold. It's unfortunate that people are putting in thousands of crores every month through SIP. As Abhijit mentioned, I have my own YouTube channel and I have created a video on SIP myths and reality. This is a great example of how investment is missold because SIP, makes us invest every month, which goes against the very first principle of investing. That first principle of investing is we have to always apply mind before we invest. Now, SIP takes away our right to think because it makes us invest mechanically. that goes against the very first principle of investing. So we have to be also very careful of such mis-selling that is so rampantly done. Another very important point is that we need to maximize our overall return on the saving pool, not just part of it. So quite often people run after IPOs thinking that it's going to be, a blockbuster listing and I'm going to get so much appreciation. But if that's going to be a very small fraction of your savings and for which you need to study before you invest, you really need to think whether that is really worth it or you can actually improve the overall return on your portfolio by following certain strategies which can actually give you superior returns over the entire portfolio. So these are things which we need to think about when we get into investing. All of us have learned compounding. We as CAs know the impact of compounding, but very quickly a table of how much a lakh of rupees can become in 25 years on a monthly compounding basis. So if we invest at 6%, a lakh of rupees, of course, pre-tax in 25 years will become 4,46,000. But if you are able to improve the return by managing our risks, and if you are able to cross or even touch 20%, the same 1 lakh has the potential to become 1 crore 42 lakh. So therefore, what we need to do is create strategies whereby we can actually climb up the return and risk paradigm. But as I mentioned, it's not sufficient to just improve the return on a small portion of our portfolio, but rather to improve it over the wider portfolio that we have, the entire savings pool. So what are the simple ways to benefit from compounding? So one of the first and easiest things to do is nurture a fewer assets that can be monitored. It's like, plant a limited number of trees that you can actually take care of. And that's how we can invest in a very simple way, but very effective way by actually focusing on limited number of assets rather than just trying to go for, plethora of assets under the name of diversification. That's actually not necessary. Once we start understanding how different markets work, and I'm going to give you a few glimpses in the next couple of slides, then we are able to focus on fewer assets and actually help ourselves with capital growth rather than just beating inflation, which is what the function of deposits really is. Also, we need to invest to grow capital rather than just generating interest or dividends. In fact, whenever interest and dividends come and land into our bank account, they're actually reducing the impact of compounding because they're then going to compound at only 3.5%, which is the savings bank rate, unless we are again able to consciously invest it. But typically what happens is because of our pressures of profession, we actually do not give enough attention to our own portfolio. And that's the reason I said that it's much better to simplify our investments. And I'm also going to show you a few simple methods before I close. So the important thing is to really focus on post-tax return possibility rather than just focusing on tax benefits. I often say this, that in India, we have a national tax saving obsession. So people are always focused on where can I save tax rather than how can I improve my return. But if we change that paradigm to improving returns, we can actually do wonders in our portfolio. It's also important to study long-term patterns in different markets. So quite often what happens is people waste a lot of their time in identifying a specific asset rather than worrying about the asset class as a whole. For example, during the COVID pandemic, the equity markets collapse was such a great opportunity. And I created a video on April 4, 2020 on my channel, how I'm going to approach this opportunity. It's available on my YouTube channel. So the important thing for us is to really focus on the market behavior rather than worry so much about every individual asset so much. So to my mind, 80% of our returns are taken care of if we are able to focus on the market behavior. The balance 20% comes out of specific assets, like a particular share or a particular mutual fund or a particular type of asset class, whether it's bond or shares. It's important for us to really understand these cycles which happen in the marketplace. And again, don't go by some of the prescribed ideas saying that nobody can time the market. In fact, investing is about looking at the right time of investing, and therefore, investing without timing is actually an oxymoron. I can understand that one can't exactly find the bottom, but we can clearly sense when we are closer to the bottom, like I have also shared in my April 4, 2020 video on my channel. So basically, this is a sense that we need to start developing about the markets. So as I mentioned, we need to keep track of long-term trends as well as short-term counterparts. So here is a 25-year chart on the 91-day treasury bill rate. All of us know that treasury bills are issued by the central government for short-term financing, and they have maturities of 91 days, 182 days, 364 days. As we can see, there is a cyclical part and also a structural part. So structurally, our interest rates are going down because structurally we are now becoming a more developed economy. We can similarly see a chart of government bonds with 10-year yields. We can clearly see over 25 years how the bond yields are falling. Now, if that is the trend, we need to also align our investments appropriately. We are fast becoming a developed nation. We are no longer a developing country. So our investments must also be aligned to take advantage of this fact. Otherwise, quite often what happens is people get stuck with investing a lot of money in their bank deposits, thinking of safety. But what happens is a falling interest rate scenario becomes a big challenge. On the other hand, it's a great opportunity for bond owners because there is an inverse relationship between bond prices and interest rates. So if you're aware about that, then we can also include bonds as a part of our portfolio rather than looking at time deposits. So as a disclosure, I have 0 time deposits in my own portfolio. I use time deposits more as a cash management tool whenever I've used rather than an investment tool. So we need to start making distinction between a product which is very convenient for cash management, for monitoring our own obligations and ensuring that we have enough money to be able to pay for those obligations, as compared to an investment tool which is going to build our capital. So quite often people confuse between these various investment instruments. So we need to be very careful about that. A couple of other charts. This is a gold chart in the global markets. So USD per ounce of gold. And we clearly see that gold is a long-term bull market because it's a proven metal which has been proven over thousands of years. So gold is something which definitely gives us excellent returns. Sensex also has given some dramatic returns as we have experienced. And I would say that bright days are ahead of us. Quite often people are very scared right now that markets have really gone up. But I would say that this is just the beginning of a structural bull market in India, because we are moving from a developing nation to a developed nation very, very fast. So gold and real estate are exciting opportunities. However, they have longer cycles. Gold has relatively shorter cycle as compared to real estate. But as I mentioned, real estate can have really long cycles. And therefore, when we invest, we need to be careful that we are not caught on the wrong side of the cycle. So whenever there is a fall in those cycles, and imagine if you have borrowed money to buy real estate, you could actually suffer from a very long-term perspective. So therefore, we have to be very careful about these cycles. Equities, as I have mentioned, provide us an excellent opportunity to compound significantly more because of market fluctuations, and also within equities as an asset class, we can have multiple assets which have their own fluctuations, and we are able to create excellent strategies around those. I have also created videos on how I deployed what I call as a switch strategy during the COVID pandemic, and you actually could create more value without actually deploying any fresh capital. So we have to start thinking of, because as CAs, we are all equipped to think more creatively, and our institute has trained us in this. Once we start applying our mind, actually there are very, very interesting opportunities that we can avail of. So equities is a sure way to build wealth. In fact, if you were to just do an analysis, you will find that Nifty has given a 13% plus return over a 17-year period. And remember, last 1 decade has been a very difficult decade for us. We have seen 2010 to 2012 period, which was marked by a lot of controversies, scams, a tremendous, lending spree which happened without much caution, and we have all suffered. The bank's position became very weak. The government had to do a lot of things to sort it out, including the insolvency and bankruptcy code, as all of us are aware about. We had demonetization shock, which was absolutely needed, but a shock which was required. We have had GST transition in spite of all the challenges, and now COVID. Nifty has given 13% plus return over a 17-year period. Is it purely out of speculation? No. In fact, if you actually see our Indian economy during this 17-year period, the Indian economy has also grown at 12%. Now, when I say 12%, I'm not talking about real growth. I'm talking about real plus the inflation. So the nominal growth in the economy has been 12%. So it's no surprise that Nifty has been able to give us a 13% plus return in spite of all the challenges. So the issue is, can it continue to give 13% plus return down the line also? The answer is absolutely yes, because 7% real growth and 5% inflation themselves add to 12% growth in the economy. If economy is going to grow at 12%, companies are going to grow at a rate faster than that. We all have studied the impact of leverage, operating and financial leverage, and how it can multiply profits. So the question is, with many major reforms behind us and ahead of us, is it an impossibility? The answer is absolutely no. We have the potential to compound. So I often say this, that quite often investors keep on analyzing which bank to keep a deposit with and deposit protection and all that. And we are all doing this for a 5 to 6% return. My question is, why can't we trust the economy, of which a bank is just a subset? So if you are willing to trust an economy, the place to invest is obviously equities, right? Also, post-COVID, we may also become a manufacturing and a defense manufacturing hub. Thus, unlike in the past where service sector was our engine of growth, down the line, we are going to have multiple engines of growth. So equities for sure is a wonderful opportunity that all CAs should definitely explore. But very quickly, because I'm conscious of the limited time that I have, and therefore I'll go a little quick and then of course leave it to the Q&A part, because I don't want to crowd out my other esteemed speaker who is going to join us at 7 o'clock. We need to accept what is called as information asymmetry in equities. Finally, as retail investors, we do not have sufficient information about what's going on in the company, in spite of we being the auditors, and we are actually the ones who certify financial statements, right? But in spite of that, of course, also to avoid conflicts of interest, we stay away from investing in companies. Like I don't invest in companies where I do corporate training, right? Just to stay away from any such potential conflict of interest. So when I look at the other companies, I suffer from information asymmetry, which means that being a retail investor, I have at most 35% access to the company's information, which is in the public domain. 65% is a black box for me. So I need to accept that, and therefore we need to create defensive strategies when it comes to investing. And that's why I was saying that risk management is very important when it comes to equity investing, and therefore my always advice for retail investors is restrict to large cap stocks due to easy access to data. You may select one or two small caps or mid caps that you have deeply studied, no problem with that, but don't run after the so-called multi-baggers, because that can be a real big trap. I have elaborated on my channel various defensive investing principles that you may like to explore. And another very wonderful opportunity that we should all explore as CAs is investing through investment and holding companies, again on which I have created videos that you may like to explore, particularly after the dividend taxation having undergone a change, as well as the reintroduction of Section 80M. There are some wonderful opportunities of investing through investment and holding companies, and they are a great alternative to mutual funds. So we need to explore that as CAs. Now, for those who don't want to invest in shares directly and are a little risk averse, here is a simple way you can actually build your portfolio, right? So you could create a portfolio which has 4 kinds of schemes. So rather than creating multiple plethora of schemes, it's much better that you select one mutual fund which is offering you all these 4 schemes. One is a money market fund where you can keep on putting all your surplus money, which you can withdraw at will because there is no entry load and exit load. And this money, is very safe, very low risk, and you can use this money to even move that to a credit risk fund. A credit risk fund is the one which invests in corporate bonds, but we have to be careful in terms of the debt portfolio. We all know the episode which happened a few years ago with one mutual fund. So we have to be clear that what kind of credit risk portfolio that this mutual fund is building. The third is gilt fund. Gilts, as all of us know, are securities issued by the central and state governments, which are very low risk as compared to a credit risk fund. And of course, index fund. Now, this index fund is something that we all should explore. As I already mentioned, the index has given you returns of 13.5% or a little more over a period of 17 years. So index funds are those which actually mimic the index, either the Nifty or Sensex or even other indices. But personally, I recommend investing in an index fund which invests in Nifty, which are the top 50 companies of the country. So if the economy is going to grow, these top 50 companies are going to grow, and we also don't have to worry about which shares the fund investor may invest money in. So it reduces our risk. And interestingly, as I'm going to explain in few minutes, it also creates wonderful opportunities, which I'll talk about, in a minute or two. Those of you who don't want to even have an exposure to credit risk fund can actually create a portfolio out of money market fund, a gilt fund, and an index fund. So money market fund gives you a lot of liquidity. Gilt fund is a great play, against falling interest rates with a lot of security. And index fund, as I've already explained, gives you exposure to equities. And those of you who want to be really more creative, you can even create portfolio with only 2 schemes. You don't have to have 15, 20 or even 5 schemes. You can just have one scheme which invests in money market fund, and you have another which is an index fund. Now you can see that even in a year, the index goes through a lot of fluctuations. And once you start studying the pattern of the markets, you can start putting money to work into an index fund when the market is slightly on the lower side, and then have a run when the market goes up. I'm not elaborating, of course, it's there on my channel in terms of these methods, but essentially we need to start taking advantage of study of the markets, the wavy pattern of the market. So while economy goes steadily, the markets always follow a path like a pendulum. They always are going to both the extremes of greed and fear. And as investors, we need to start learning that method in the madness. So as we learn that method, we are able to very clearly take advantage of those patterns and put our money to work. So one can even creatively manage one's money without much hassle. So you may remain busy in your own professional activities, but all that you need to do is just study the markets and put your money to work. And if you feel the market gets overheated and you have generated superior return, you can move your money back into a money market fund back also. Always, when you invest in mutual funds, go for open-ended schemes. They provide you enough liquidity. And all of us know that there is an option of direct schemes versus regular schemes. Direct schemes are those where we can directly go and invest without going through any broker, and that actually enhances our return by at least 0.25%. Go for simple, straightforward schemes. Don't get into complicated schemes which combine asset classes. Remember, whenever there are these complicated schemes which are offered by mutual funds, the total expense ratio, TER, as it is said, becomes also higher and higher. On an index fund, if you go through a direct route, you will end up in paying only 0.1% per year as the expense ratio. On the other hand, some of these managed schemes, asset management companies charge as high as 2.5%. Now, globally, the experience is that only 8 to 20% of the fund managers globally, varies from country to country, have been able to beat the respective index against which they are benchmarked. So a lot of money is moving to index funds, and it has already become a $3 trillion industry because people say that, why should I trust a fund manager? I would rather trust the economy, and then I would put the money into an index and also reduce my expenses, which are going to be charged for managing my money, right? Third point, observe the market movements and don't go for SIP, as I already mentioned. And as you get the rhythm, you can move from portfolio 1 to portfolio 3 gradually. So, the risk return tree, you should always climb in a step-by-step way rather than trying to rush. So, Abhijit ji, I hope in the limited time which I had, so that I have also kept some room for Q&A, I have been able to give the justice to the topic that you have assigned to me. And I hope it would have met the expectations of my CA brothers and sisters. Thank you.
Thank you so much, Abhijit sir. It's a wonderful session, I would say, and it requires not less than 3 to 5 hours to understand your all concepts. A few takeaways for me personally are like mis-selling of SIP. This is a new concept for me. Really wonderful. Nurture few assets than having more assets in your basket is another takeaway. Dividend is reducing your compounding rate is again yet another takeaway. National tax saving obsession. This is a wonderful thing. I think we need to think more on this particular aspect. Investing with timing is a oxymoron, is another thing I have learned today from your deliberation. And investment and holding companies. It is a new idea today I have learned. Sir, I wish we should have a full day program from you wherein we'll be able to know various things about investing. There are few questions which are being directly messaged to me. I will ask 2 of them only because we'll be having a speaker. The first one is for a busy chartered accountant, it is been assumed that SIP is the only best way to invest because he is not having time to think about other investment. Though it is so-called expert, being a chartered accountant or any other company secretary or CMA, he is not having time, as you rightly mentioned, to think about the market, the economy, and the better company. So he generally thinks that the SIP is the best way. What is your take on this?
Yes. So, Abhijit, only one point. I think one of the takeaways that you mentioned was that investing with timing is an oxymoron. I would rather say the other way. Investing without timing is which is not thinkable, because investing always has to be backed by thinking. And as I mentioned, SIP is something which takes away our right to think. SIP makes us mechanically keep on investing money. I have actually created a video picking up arguments in favor of SIP which are published, and I'm sure they are even published as of now, on one of the largest mutual funds, and I have actually argued against each of those arguments in favor of SIP. For example, one of the biggest arguments in favor of SIP is that nobody can time the market. Right, but actually that's not the case. Understanding the market is the very first step in investing, right? And even if we are very busy, we can definitely spare about half an hour every week to just observe what is going on in the markets. That's why I said that you don't have to worry about selecting a specific mutual fund, or you rather worry about how the market is behaving, and you can simply invest in an index fund. And you can rather control at what time you want to put that money into an index fund. Otherwise, your money can simply lie in a money market fund. I'm not saying it needs to lie in a savings account. It can move to a money market fund from where you can easily switch to an index fund at your will, right? I'll give you an example. During demonetization time, the market had cracked because everybody was worried what the impact on the economy was going to be. I remember the Nifty was at about 7,900 level. Every day, because nobody can know the exact bottom, that there is a lot of fear, there is a lot of concern in the market, and that this is the best time to invest. Always remember, the best returns are given when we invest when the market is very, very fearful. For example, those who have invested during the COVID pandemic in March, April last year have doubled, or in some cases 3 times, 4 times of the money, for the simple reason that that was a crime time for investing. Now, we don't know the exact bottom. Those of you who like to see my April 4 video on COVID and equity investing, they can look for that video. I have very clearly explained why it's a great opportunity. Now, when we know that we are in a very weak zone of the market, but we don't know the exact bottom, we can stagger, over a couple of days our investments. And I remember from 7,900, that's what exactly I was doing in an index fund during that period. And December 2016, 7,900 index rallied to something like 11,500 by February 2018, just in a matter of 1 year, 3 months. So see the kind of returns that the market can generate if we are able to develop a sense of time about the market, simply the waves that happen in the market. So I think that's how I would like to answer that question, Abhijit ji.
Thank you. Another question is again interesting. Someone has asked that what is your idea about investing in annuities that are being offered in market?
Right. So, as I mentioned, and as Abhijit ji picked up, one of the learnings was in terms of the dividend and interest coming to our bank account. So what is going to also happen is the annuities as an idea is also, typically I'm talking about the pension products, which are going to put certain money into our bank account, after our retirement date. But, this is again where we need to start thinking of a completely different paradigm, where instead of some money coming into a bank account, we should be able to control, withdrawal of money. So, and therefore, the principle that I advocate is, let us stop living out of interest and dividends or certain annuities coming to our bank account. Rather, let's start creating strategies for creating a larger capital pool from which we can withdraw whenever we have any specific need. Otherwise, it can continue to compound. So therefore, I would never invest in an annuity product, because I don't want money to come into my bank account unless I really need it.
Anyway, thank you so much, Abhijit sir. Mishra ji, is there any facility to raise hands or ask question? If anybody wants to ask any question, the house is open. Hello. Okay, so I think there are no such questions since the time is limited.
Sure.
So thank you so much, Abhijit sir, for your precious time given. Thank you for all the wonderful things you have taught us, and